what we tend to build is successful companies. That's what we see as our core job, helping founders succeed.
Yeah.
It starts with investing well in good quality founders, in good quality companies, but spending time, our own time, bringing our experiences into that. We tend to invest in companies with founders, at least 2 founders, if not 3. Right? So between them, there is a fair amount of experience and complementarity in the experiences to be able to build and scale an organization. But there are so many stages. There are no 3 people can come together and be absolutely certain or have a high degree of certainty on their ability to foresee and preempt and deal with risks, right? And there will always be risks coming up in any founder's life. And to have a lot of supporters around you, other investors that come on the cap table along with us. We typically lead our investments, lead the rounds when we invest. But we have a lot of supporters with us that work with us, and we've got all sorts of arrangements to be able to do that. And bringing these supporters, some global organizations, some very specific individuals that relate to a particular company in the portfolio, to come together, suitably incentivize, etc., to bring those extra levers where there might be some hole or capability gap as far as a company is concerned, depending on what stage they are in, right? And in our experience, that makes a clear 2 to 3x difference across the portfolio, at the portfolio level, right? And that's a huge thing for us. And then, when it comes to exits, these relationships that a firm like ours can have or does have with people, if you really bring that to bear, you create more opportunities for follow-on rounds, more successful follow-on rounds, and then eventual exits for us. Right, so it's so many ways in which that works for us, but it's a win-win. That's a fundamental here.
Amazing.
Right? That's a fundamental point. It's about building, enlarging the pie so much that no one in that ecosystem has to worry about the size of their individual slice. Right? That's a core principle.
Right.
And some funds do that really well. We like to do that, and more funds are starting to get that too.
In one line, don't get involved. No, I mean, I'll double click on that a little bit. Look, founders are the stars of the show, right? But you can get the biggest stars in the world. If the script doesn't have meat to it, the movie's going to tank.
Right.
So there has to be some driver of a company's right to win. And while founders are a big part of the puzzle, they are not the whole puzzle.
Yeah.
Right, so there has to be some axis of innovation where the companies build something tangible. And for us, in terms of our thesis, our mandate, it is to invest in tangible differentiation, right? So bottom line, don't get involved.
I'd sort of add just a little bit flesh to that, and on that, a couple of minor points really. One is, differentiation, innovation may not always be on the technology, on the technical product.
Yeah.
Sometimes it's, there always needs to be a good technology that is highly scalable, but it may not be the significant driver of innovation. It's sometimes the business model that is highly innovative.
Right.
And so it's a combination of the technology and the business model. So we look at that very acutely. And the best technology without the right business model is not going to go anywhere anyway.
Of course.
Right? And the second point I'll make is that, which I've learned over my 25 years of doing this now, is competitive advantage is short-lived. The ability of a set of founders and the ecosystem that they operate in, and their teams and the systems and culture that they build, that continues to innovate, continues to drive new ways of creating advantage in the market against their competition as new competition comes up. That's a long-term journey, and one of the big things for us from a founder perspective is, do they have the mindset to not rest on their laurels? I've got a great product. I just need to sell, and I'm going to be fine. That will work for 2 or 3 years. If you're super lucky, that'll carry on for another 5 years. But mostly it doesn't. Something or the other is going to happen, right? And to innovate preemptively, as opposed to reacting to some big change, that's a mindset, right? That's a culture, and that's important to look at. Education, right? I mean, we all know the bloodbath that's been going on in the last 3 years in the education sector. But I mean, NM would talk about this all the time, and mentioned this earlier as well, that one of our companies is an edtech company. There's 26 crore kids in the K-12 system in India who are massively underserved. The reason they are underserved is because they can't pay very much. And the cost of customer acquisition is very high with the traditional models that have been used in the last few years with B2C tech plays in the market, which just makes it really, really difficult to continue to grow and drive profitability at the same time, right? So the unit economics chasm continues to deepen, and that causes all sorts of issues after that, and then and we are where we are. So the sort of general sentiment in the market for edtech is low, to say the least. And so our contrarian bet in the middle of all of this was in YOLO, which has taken a business model that is a B2B2C kind of business model with unit economics that are a fraction of the equivalent B2C model, and inspired innovation in the business model itself and the use of the product that they have in a way that allows their model to scale while driving profitability. I mean, it's that the Bharat play on education, right? Where the focus is small tickets, but a very large number of, very large volumes. You multiply the two, but your business model needs to be able to operate that. You need to be able to scale it. As I was saying earlier, it needs to be done well, thoughtfully, carefully, and not everybody can do it. And when it can be done, it produces amazing results.
Right. So I think sourcing is a big competitive advantage in our business, right? I think it's a lot. There's a bunch of folks probably who think just get a good set of people together and serendipity takes care of everything and you'll get the right deals. It probably worked like that 10 years ago when the market was a lot smaller, the ecosystem was a lot smaller. But now sourcing has to be done very deliberately. We've built a very, very scientific engine around it. We think about founder pools and we think about how do we access these founder pools, right? So for us, the top 5 founder pools are your Ivy League graduates, which is your IIT, IIM graduates. You have your serial entrepreneurs. You have folks stepping out of startups to sort of build their own businesses. You have professionals who've spent time in large enterprises kind of coming out to set up their own businesses. And lastly, you have folks coming back from international markets with those global experiences coming back to India and building their own businesses. And we've got 16 inbound plus outbound methods or channels, as we like to call them, which ensure that we've got deep inroads into each and every single founder pool. What helps, of course, is the fact that we are a thesis-driven, we are targeted, we're not generalist as an investor. If I was to know about everything that's happening in the market as a generalist investor, I'd probably need a team of 100 people sitting with me doing this, because that's how deep the market is and that's how quickly it moves. But within our scope, I think there isn't a single deal that we don't see. We may not do it. We may not evaluate
not
it.
A
further.
single company, right?
Not a single company.
Before they do a deal.
Yeah, even before. Yeah. So, for example, most of our companies we've tracked for years. Right, Data Motor we tracked since 2020, did the deal in 23. Discovery tracked since 2018, did the deal in 23. Similarly, Yulo knew the founder from he's a serial entrepreneur, had engaged with him in his previous life and his previous company, kind of had that relationship from that point onwards. So of course there is value in having a certain vintage in the ecosystem, but beyond that, it is very much a deliberate process of going out there, making sure that you work those 16 channels really, really well to make sure that the top of the funnel is as wide as it can.
I would say one thing, and I'm sure you have things to say as well. My thing is build a real company, not on a fad. Build a business that you can actually see a clear path to profitability on, real cash flow. Take your cue from the corner shop, take your view from all the conventional companies that have stayed for a long time. Don't build for a company that you can exit in 4 years. Think about building an institution, and everything else will come together as a result, and use as much help as you can possibly get from the people around you.
Beautiful.
Bite people's arms off if you can.
Amazing.
And I'm sure you have something.
No, I think I'll largely echo what Amit said. Right, good businesses will always find supporters. So instead of chasing what amount you've raised or what valuation you're raising your rounds at, and I've had founders come to me and say, this is what I've raised in the past. It really doesn't matter. As much as it, kudos to you for having done that. It's about the quality of the business that you're building. Are the fundamentals solid enough? And this is something that we talk about quite often. Is we like founders who make our lives miserable by asking us for help every waking second of every day.
Amazing.
You can't build everything on your own, and the more people that you have an ecosystem around you, the more you leverage that, the better.